Welcome to The Explainer. Today, we're tackling a massive economic puzzle, one that's been bugging economists for over a decade. Why has government borrowing been so ridiculously cheap? We're going to dive into a pretty groundbreaking paper that offers a surprising answer, and it totally changes how we think about one of the most powerful and controversial tools of our time, quantitative easing. So let's just start with the mystery itself. Since the financial crisis, governments around the world have issued literally trillions and trillions of dollars in new debt. Now, Basic Economics 101 tells you that should make borrowing more expensive, right? And yet, long-term interest rates have stayed at these bizarrely low levels. It just seems to fly in the face of the basic laws of supply and demand. And the story really kicks off right here. After that 2008 meltdown, central banks like the U.S. Federal Reserve, led by figures like Ben Bernanke and later Jerome Powell, went on an unprecedented buying spree. They bought up huge quantities of government bonds, and this policy, which you can see just exploded their balance sheets, became famous, or maybe infamous, as quantitative easing, or QE for short. Okay, so this massive expansion of QE, it created a major disconnect in the bond market. I mean, a genuine puzzle that when you look at all the historical data, it just doesn't seem to add up.
You see, the old rule of thumb was super simple, and it made perfect sense. If a government wants to sell more bonds, increase the supply, it has to make them more attractive to investors. And how do you do that? Well, you offer higher interest rate, a better return. So more debt should have meant higher borrowing costs, period.
But after 2008, that rule just completely shattered. This graph shows it perfectly. That top line is where interest rates should have gone, based on that explosion in government debt. And the bottom line, well, that's what actually happened. They just stayed stubbornly, confusingly low, creating this massive gap between theory and reality. And listen, this gap isn't just some academic rounding error. We are talking about 150 basis points. That's 1.5%. In the world of global finance, where literally trillions of dollars are sloshing around, that is a colossal, economy-shaping number. So what on earth was going on? The common explanation, the one you hear in the news all the time, it really focuses on the direct mechanics of QE itself. So the simple story goes a little something like this. The central bank wades into the market and acts as this massive, unstoppable buyer of government bonds. All this new demand drives up the price of those bonds. And because bond prices and their yields move in opposite directions, the yield, which is really just the interest rate, goes down. And voila, it's cheaper for everybody to borrow. Simple enough, right? Well, not so fast. Here's the big twist. When you actually run the numbers, this direct buying effect, as powerful as it seems, it can only account for about a third of that giant 150 basis point gap we saw earlier. That leaves 2/3, the vast majority of the effect, totally unexplained. The common story is missing a huge piece of the puzzle. And this is where we get to the really cool part. This brings us to a new theory from economists Haddad, Moreira, and Muir, which reframes QE as something much, much more powerful than just a simple transaction. They argue that we've been looking at QE all wrong. We shouldn't see it as a series of one-off, surprise interventions. No, instead, we should see it as a predictable policy rule. Think of it as an implicit promise, a backstop from the central bank that basically says, hey, if the economy hits the fan and markets start to panic, don't worry. We will step in and buy bonds to keep things stable. I mean, this is a really fundamental shift in thinking. On the left, you have the old view, QE is just a one-time purchase. But on the right, you have this new theory. QE is a recurring promise. It's not a transaction, it's an insurance policy for the entire bond market, and it pays out whenever there's a crisis. And this is the absolute key, and the paper puts it perfectly. Because investors know the central bank has their back and will step in during a crisis, government bonds become a much safer asset to hold all the time. The promise of something happening in the future fundamentally changes how people behave today. So let's actually follow the evidence trail here, because when you start to look at the data through this new insurance lens, a lot of the weird things that didn't make sense before suddenly start to click into place. So clue number one is this mystery of the weakening announcements. The very first QE announcements back in 2008 and 2009, they caused massive drops in interest rates. But then, later on, you'd get these announcements for even bigger sums of money, and the market would barely even shrug. Now, this is a real head-scratcher for the old theory. I mean, if QE is all about the quantity of bonds being bought, shouldn't bigger announcements have a bigger impact? Why did the effect seem to just fade away over time? The answer? And this is really the smoking gun for the whole insurance theory. It isn't found in the bond market at all. No, it's hidden in the options market, which is like this fascinating window into what investors are actually expecting to happen down the road. So get this, on the exact days of the very first QE announcements, the perceived long-term risk of holding government bonds, what traders call implied volatility, it absolutely cratered. It fell by a whopping 35%. And that tells you everything. This wasn't just a reaction to a few $1 billion of bond buying. No, in that moment, investors everywhere understood that the fundamental rules of the game had just changed. A permanent safety net had been switched on, and they priced that new reality in almost immediately. So, when the authors of the paper actually built a model to quantify this insurance effect, well, the results were absolutely stunning. What their model shows is that the common story, that direct effect of buying bonds, it only accounts for about a third of QE's total power. The other two-thirds, the silent majority of the effect, comes from this insurance channel. It comes from the promise of future intervention, not just the action itself. And this insurance effect all by itself is powerful enough to lower long-term interest rates by 75 to 100 basis points. And that completely solves the puzzle we started with. The secret ingredient, the missing two-thirds, was the insurance policy all along. So, to wrap up the key takeaways here. First, QE isn't just a bunch of random, one-off purchases. It's a predictable rule. Second, that rule acts like a powerful insurance policy for bondholders when things get ugly. And third, it is this insurance channel, not just the raw buying power, that is the main reason interest rates have been so low for the last decade and a half. And all of this leaves us with a critical, multi-trillion-dollar question for today. For 15 years, this unspoken insurance policy has been the bedrock of financial stability. But now, as central banks start to unwind all of this in a process called quantitative tightening, they are in effect canceling that insurance. So the question is, what happens to the entire financial system when the ultimate insurer decides to just walk away?